Accounting equation and Excel. Write checks or pay cash for expenses and prepaid assets. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation, using Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our crunching numbers is my cardio product line. Now, I'm not saying that subscribing to this channel, crunching numbers with us, will make you thin, fit, and healthy or anything. However, it does seem like it worked for her. Just saying. So, subscribe, hit the bell thing, and buy some merchandise so you can make the world a better place by sharing your accounting instruction exercise routine. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. We are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet, but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, 3 tabs down below. Example, practice, blank. Example, in essence, answer key. The practice tab having pre-formatted cells so you could practice the practice problem with less Excel formatting. The blank tab, the one we will be working on, is where we started with a blank worksheet but are basically working within a template now. However, we will be adding to the template as needed as we go. Let's go to the example tab to get an idea of what we will be doing. Quick recap of what we have done thus far. We're thinking about the accounting equation, using it as our accounting system, basically our trial balance from which we will construct our financial statement reports, that being the balance sheet, the income statement. We started off pulling in our beginning balances, imagining we had a prior accounting system with some prior balances within it, then gave some normal transactions for a startup business, the need for cash to buy the startup necessities, inventory, property, plant, and equipment, that cash typically coming from either the owner or from a loan. Once the cash is in the bank account of the business, we can then use it and recorded transactions for the purchase of inventory and property, plant, and equipment, those investments necessary to help us to then generate revenue. Then we went and started doing the business of selling our inventory, in our case, guitars, as well as service items, which we can imagine being, say, tune-ups on the guitar and guitar lessons. And now we're continuing on, getting towards the end of the month. So now we're imagining it's towards the end of the month and we're paying some of those normal bills, which often happen in a cyclical type of process, paying the monthly utility bill, the telephone bill, and so on and so forth. Now, when we pay off these bills, there's a couple different ways we could think about doing them, which will depend in part on the type of industry that we are in and possibly the size of business that we have. In other words, what we would like to do typically with accounting software is try to automate things as much as possible. And with the monthly repetitive bills, that's where you have a lot of times the biggest potential for the low-hanging fruit to try to automate things, because those are the things easy to automate. So for example, if the utility bill and the telephone bill come around every month, maybe we try to do an electronic transfer to automatically pay those bills and process the payment automatically with our accounting system with the help of bank feeds as they clear the checking account. So that would be great. However, if we're in a larger kind of accounting system, it might be the case that time value of money becomes more important. In other words, when the utility bill becomes due, it usually sends you the bill and says, hey, you got a month to pay it. You could pay it at the end of the month. If you pay it now, when you get the utility bill, then you kind of you could have held on to the money for 15 more days or 30 more days. Now, normally that doesn't matter for small businesses when we're talking about fairly small dollar amounts. But if we're talking about businesses that have a whole lot of transactions, thousands, tens of thousands of transactions, and they have large dollar amounts, holding on to the money for 15 more days becomes more important. And that's when we might put it in the books as accounts payable and then pay it as late as possible according to the terms, as long as we can avoid penalties. So that's the general idea. So if you're a bookkeeper, the mindset is typically going to be, am I working in a relatively small to mid-sized business, in which case I want to focus on automating the business, possibly paying as many of the repetitive bills with the help and the use of bank feeds. And if it's a larger business, then maybe I want to specialize by working within accounts payable so that I can create value by paying off all those transactions a little bit later, which has a significant impact with larger dollar amounts and with many transactions. Okay, so we're going to be paying them off with cash. Now, it used to be a check that we would write a check, of course, to pay off our utility bill and so on and so forth. These days, some people still use checks, but a lot of times things are going to be automated. Now, that leads to another problem with terminology. The fact that we have automated the system and are paying it off with an electronic transfer does not mean that the check form, in essence, has gone away, because the check form is the data input form we typically think of, which decreases the checking account. Now, in some softwares like a QuickBooks, they'll have a difference between a check form and an expense form. So sometimes they'll call it the expense form, but it's basically the same thing. It's the same exact form, basically, except the expense form doesn't have a field for a check number because it's going to be like an electronic transfer. But just keep the terminology in mind. As things change in the way the payments happen, we still need to name the data input form, which often takes on the name of the old paper form, which triggers in our mind a check as though we think of it as just a physical piece of paper. But that's not how we're thinking of it here. We're thinking of the form that decreases the checking account, whether it be an electronic transfer or some other form. Now, notice that we've looked at kind of check forms in the past, which were specialized kind of, or we might have specialized check forms, like paying off the accounts payable, for example. That was a form that we had a bill pay form that we thought about, which is basically just a check form because it decreases cash, but the other side will always go to the liability account of accounts payable. So again, that just by looking at that form, I know what the journal entry is because the form itself tells me. Whereas with a check form, we're going to be paying down the cash. I know that cash is going to go down, but I don't really know what the other side is. And again, sometimes QuickBooks, for example, calls it an expense form, which would lead us to believe that every time we use that form, it's going to be some kind of expense. But that's not necessarily the case either. That term is also misleading to some degree. I could see why they used it, but we could decrease the cash in order to buy an asset. We might be buying property, plant, and equipment. So it's possibly most likely that we use the check or the expense form, which is a check form, in order to pay for an expense, but we might not, because we might be buying like an asset, for example. Okay. All right. That said, let's pay some of these off. We're going to say the first one's going to be 126, and then we're going to say we pay cash for insurance. Now, most businesses have to deal with some kind of insurance, such as liability insurance, for example, and it is an expense. But insurance, we're starting off with the funny one, because a lot of times when we buy liability insurance, we might pay for it monthly, in which case it might be just easiest to do to just write it off monthly, and that would be fine, possibly. But a lot of times we pay for the insurance like a year or 6 months to a year in advance, because we get a discount to do that, and therefore we have an incentive to do that. And then we run into this problem of, well, I'm paying for the insurance before I actually consume the insurance, a problem we don't have with like the utility bills, the telephone bill, in which case they provide the service first. We've already consumed the water, the heat, the telephone, and are now paying for it based on the calculations of how much we consumed. With insurance, it's not the case. We're paying for it before they insure us. It's also a little bit confusing to know what we're actually getting, because you might say, hey, I don't get anything from insurance unless someone sues me and then they help me deal with that lawsuit situation. But that's not the case. The insurance is giving us coverage. It's lowering our risk. So even if no one sues us, we still paid for something. We paid for coverage. We paid to lower the risk. So that's going to be something in the future. So we have a similar kind of situation here as we do like with the extreme case of us buying, say, a building. So if I buy a building for $100,000, even if I paid cash for it, you would naturally say, no, I'm not going to put it on the books as building expense. I'm going to put it on the books as an asset. Why? Why does that make sense? Because I'm not going to consume the building now. I'm going to use it as an asset to help me generate revenue in the future. I should allocate the cost over the useful life, which is going to be quite long. Similarly, if I prepay for anything, the most common prepayment being insurance, then I haven't yet consumed the insurance. So from an accrual standpoint, I should put it on the books as an asset and then expense it as time passes. The problem with that is it's more tedious to do, and it's a little bit harder for us to do our bank feeds and our automated system. Cash system is easier. So then the question comes up, do I have to do that or not? And it really depends on your bookkeeping system. Are you on cash or accrual? The easy thing would be cash. The harder thing would be accrual. And if you're in the United States, what about taxes? So taxes will also often come into play, where the tax code will often force us in some cases to be on a cash basis or accrual basis. So you might want to talk to your tax preparer to see what the best system is for your insurance. We're going to do the accrual thing here, put it on the books as an asset instead of as an expense, and then we'll do adjusting entries, expensing it as time passes in a future presentation. So we'll put it over in, let's put it next to the inventory, and then we'll put it right here. So I'm going to select the whole column P, right click and insert. That puts a column to the left of it, and I'm going to call it prepaid wait a second. Hold on a second. Prepaid space, not enter, insurance. Okay, so there we have it. Prepaid insurance. Hopefully I spelled it correctly. If not, I will check that later. But there we have it. So then in that account, we're going to put the increase of $12,000 as an asset. We're not going to get cash for that asset, but we're going to consume it in the generation of revenue in the future by having coverage. So then the other side, where am I going? The other side is just going to be to cash. So negative to cash. So we paid cash, might be an electronic transfer or whatever, $12,000, and the other side is going to insurance. Therefore, no impact on the accounting equation because one asset went up, one asset went down. Let's put the zeros across the board. Zeros across the board. And there we have that. Now, nothing happened to the income statement. When is it going to hit the income statement? Periodically, when we do the adjusting entry, reducing the asset, recording the expense for the amount that has been consumed. On either a monthly basis, we should do that, most likely, or on a yearly basis at least, so that we can have our yearly financial statements populated properly for our reporting, as well as possibly for income tax purposes if you're in the United States. Let's bring down the balance. We'll sum this up. Equals the sum of the prior balance and the current activity. We're going to copy that, Roger, paste it across, just the formulas only, and okay, dokay. Let's go back on over. Let's bring down the balances. We're going to bring down the balances. We'll put an underline. So there we have it. All right, let's do another one. More typically, we'll pay for supplies. Supplies is going to be something that may not happen like weekly. You might have some supplies that you always need, and you have like it's set up almost automatically to be purchasing them, but they happen somewhat periodically. So let's say we pay cash which could be an electronic transfer, a check, or whatever, right? Or cash, right? For supplies. We could be in the store buying supplies, or we might buy them online with an electronic payment of some kind. Point is, the cash account is going to go down, and so that's going to be the idea. That's why we're using a check form or expense form, if you want to call it that. All right, now with supplies, we have a similar kind of situation because different companies will deal with supplies differently, meaning if your supplies are really important and you want to track them somewhat like inventory, then you might have to put them on the books like inventory, treating them basically like inventory using a flow assumption, such as, for example, with medical supplies. If you have drugs and stuff like that, then you have to make sure that you track them because people might try to break in there and steal them or something like that. So they're going to be important. That means you have to put them on the books as an asset, kind of like inventory, and then use a flow assumption in order to track them to make sure that you're properly managing the supplies. However, if you have small supplies, you're buying like staples, paper and whatnot, and you're not so worried about tracking the supplies, then the easy thing to do would be simply to expense them. Now, of course, if you expense them, it's more likely that people are employees steal the supplies and whatnot, right? So you probably have to keep an eye on them still, but that's the easy thing to do. Now, notice in theory that if the supplies are going to last more than a month or a year, for example, in theory, we should put it on the books as an asset and then depreciate or expense the supplies as we consume them. But that takes more work, right? That's going to be more tedious to do. So it really depends on the industry that we're in as to whether or not we're going to put the supplies on the books as an asset or an expense. One other thing to keep in mind with supplies, when you pay the vendor for supplies, it might be something like an office supply shop or something like that, in which case you have to watch out as to whether you're paying for supplies or inventory, or if you're paying for property, plant, and equipment. You might buy all those things from the same office supply shop. So that means that the dollar amount, you might put a dollar limit on, say, like your cash transactions that go through a bank feed and say, hey, look, if the dollar amount is less than like 1,000, let's say, I'm just going to expense it as supplies. But if it's over 1,000, I don't want you to automatically expense it as supplies. I want to at least look at it to see if I should be putting it on the books as an asset, property, plant, and equipment, or possibly similarly with inventory. You might have an issue with that. You have to figure out some way to want to automate your system, typically within like a QuickBooks with bank feeds, but distinguish between types of accounts that might be going to different places but have the same vendor. All right, just to keep that in mind, cash is going to go down, decrease the cash. Other side, we're just going to expense it. That's the easy thing to do. We're doing the easy thing. This time, office supplies, expense is going to go down. Well, the expense is going to go up, bringing net income down, or and equity down, which will bring equity down. All right, let's put the zeros across the board. Zeros across the board, and our normal routine. It's important to have the routines, keeps you in the flow here. We know this process. Put an underline here, an underline here, an underline here, just the normal routine. And then we will bring down the balance. Let's see if our transaction is in balance first, copying this down. So this time there was a change. There was no change up top because, of course, one asset went up, one asset went down. Here, cash went down, but the other side went to the equity. So equity went down. Bringing down the balance equals the sum, prior balance plus current activity. We're going to copy that and paste it across. Crossing the board again, across the board, across the board. And there we go, pasting just the formulae. All right, next one. Next common payment that happens monthly, we're just going to call it utilities. It might be the electric bill. It might be the trash bill and so on. But I'm just going to call it generically pay cash for utilities. Now, notice utilities, with the expenses, the thing to note with expenses is we have the most leeway typically with expenses on the bookkeeping side to decide how much detail I want on my income statement. In other words, I could group expenses together, or I could ungroup them and have more detailed within my income statements. There's trade-offs to both of those kind of formats, because like you can imagine an income statement that just has income and then expenses, and put all the expenses into one account. That would still give you net income, but the expense category would be too limited, and it wouldn't even be sufficient in order to generally make your income taxes if you're in the United States. You at least need to break out some detail. If you have cost of goods sold, you're going to be required to break that out because that's what the IRS is going to want. But most of the other expenses, typically the IRS is going to expect, and I'm saying IRS because that's the minimal requirement for reporting purposes, even for a small business in the United States. But even for internal purposes, if you're outside of the United States, you would typically want the normal categories of, like, utilities versus supplies and insurance and that kind of thing. However, utilities is the classic example that it used to be that we had the telephone, the trash, the electric, the gas was all under utilities. But these days we break out at least the telephone, because the telephone has become quite significant, and therefore it makes sense for us to have it in its own account. If you're in an industry that uses a lot of electricity, then you probably want to break out the electricity in its own account as opposed to the gas and the trash and the so on, so that you can track it more specifically. You might not need to for tax purposes. It doesn't matter as long as the net income is the same, right? Because there's no special treatment of that expense account for taxes typically. But you might need to break it out for your internal purposes to give you more detail. On the other hand, if the electric bill is quite small, as well as gas, as well as trash, and you have all these minor utilities, breaking all of them out, adding 10 accounts instead of one account, will make your income statement long and tedious, possibly not giving you the added detail that's relevant, necessary in order to increase the statement. Now, also note that you could get fancy with formatting in software like a QuickBooks or Xero using, say, sub-accounts. So you could say, I'm going to put it under utilities and then have a sub-expense account of gas, telephone, electric, and so on and so forth. That gives you kind of the best of both worlds, because it allows you in some cases to collapse in some reports to just utilities and expand when needed to give more detail. However, it's still more tedious to deal with from a bookkeeping standpoint, because you're going to have more accounts that you got to deal with. All right, those are the pros and cons. Let's put an underline. Wait a sec. Hold on now. That's done here. Utilities is going to go down on the cash side. Decrease in the cash. The other side's going to utilities. Utilities. All the way at the end. Decrease to the utilities. Boom. Let's put some zeros across the board. Zeros across the board. Zeros. And one. There we go. Let's put an underline. A line underneath. We call it an underline. I feel like that's self-explanatory because the line goes under, so that we appropriately named it. And then we're going to let's copy this down. This was the balance from last time. We'll copy it down one at a time. We're out of balance until, boom, green zeros. Let's put an underline under these. And now we're going to copy it down to this transaction to see if we remain in balance. Cash went down, therefore assets went down by 620. Nothing happened to the liabilities. Equity went down because the income statement went down because expenses went up, which brings net income down, which brings total equity down. Okay. And then we'll bring down the balance. Summing it up equals the SUM. The SUM. And we'll copy that across. Pasting it just the formulas only, not messing up the formatting for formatting's sake. We'll paste it with just the formulas. And then we got one more to go. One more to go. One more to go. And then we'll sum this up equals the sum. Wait, no, that's not how you do it. Then I'm going to copy this down. There's my balance. Copy this down. Red is going to turn green, hopefully. Boom. Put an underline under the ones up top. Home tab, font group, underline. One more time. Enjoy this one because this is the last one we get, and then we have to stop for now. Pay cash for telephone. So once again, telephone, monthly bill, something that happens repetitively. If we're paying cash for it, hopefully we can automate that for most bookkeeping services and just pay it as the bill becomes due using the bank feeds, which would just decrease the checking account. And the other side, we typically break out these days, small businesses, large businesses, whether you use the phone or not, it's usually an expensive enough bill that we don't put it into utilities anymore, but we call it the telephone bill. We might even break it out to multiple telephone bills based on location or something like that. So we can track who's talking on the phone and say, hey, look, this person spending all their time talking on the phone. There's not that many meetings going on here. You don't need to be on the phone that much. We need to track this person phone talking. Cost to me. What is this? This is not essential talking time. Let's put some underlines under this. Underline, underline, underline. And then we'll bring down the transaction. Are we still in balance? 410, 410, or nothing there. 410, back in balance. Bringing down the balance. Uno vez más, one more time. Por favor, equals the sum of this plus this, and then we'll copy that and bring it across the board. Otra vez, la última vez, last time, and then we have to stop, even though it's good times. Even though it's good times, this is the last time. So we're going to paste it. All right. So let's copy down the ending balance. Ending balance, copying down. The red is going to turn green, hopefully. It does. Underlines, home tab, font group, underline, boom. All right. So so once we have these transactions set up in the first month in, say, accounting software, if you're using bank feeds, for example, you might be able to automate the whole process, even with the insurance, which didn't go to an expense. And basically, and that's great for bookkeeping, the efficient thing to do. Oftentimes these days, one business model you might have, in other words, as a bookkeeper, is to say, I'm looking to automate my system as much as possible with the use of the bank feeds. And then I'm going to use and depend on either myself or an external tax preparer or financial statement, an accountant, that's going to compile the information that I have put together basically on a cash basis in order to do whatever needs to be done at the end of the year, which might include for the United States income tax preparation, as well as, external reporting, loans and whatnot, whoever you got to give the financial statement reports to. And that means at the end of the month, you can kind of separate those two duties so that, again, on the bookkeeping side, your focus is to streamline everything as much as possible, trying to figure out those areas where you can't and how can you work around it, possibly adding more work on our end if we need to, or possibly working with adjusting entries at the end of the year so the accountant can easily just shore up the books from a cash basis to whatever accrual needs are there. Those accrual needs typically are going to be there, for example, with the insurance, because the insurance is just going to keep on going up on our end as we automate the process. Every time we pay for insurance, it's going to increase an asset instead of an expense. The asset will not close out to equity like the expenses will. You have to do that manually. That's the problem with that accrual kind of component, which means you need to do adjusting entries at the end of the month or possibly year, which we can do, or possibly we can have our accountant do as they finalize the books in order to do something like taxes or year-end preparation. Similarly with payroll, similarly with inventory, messes up our cash-based system, and so on and so forth.